Welcome to this explainer. Today we're taking on an absolute monster of a topic, and look, we are going to completely strip away the sci-fi romance of space exploration for a few minutes. We're going to evaluate the inevitable SpaceX IPO strictly through the cold, calculated lens of a professional financial analyst. I know retail investors already foaming at the mouth for this one right space, reusable rockets colonizing Mars, the future of humanity. It all sounds incredibly cool. But if we want to figure out the actual investment potential here, we have to look past the stars and dig deep into the balance sheet. $210 billion. That is just a staggering private valuation, and it makes this one of the most anticipated IPOs in history. We already know the goal is to eventually take this public, and when it happens, literally everyone is going to want a piece. But you really have to ask yourself, what exactly are you buying into at a $210 billion valuation? To really get what's going on with this company, we have to contrast the mainstream hype that retail investors buy into with the pretty uncomfortable financial reality that institutional analysts are staring at. The narrative is visionary right, revolutionizing space and making humanity multiplane, but the financial reality, at its core, SpaceX is a defense and logistics contractor. It just happens to be exceptionally good at building rockets, and as we're about to see, rockets come with absolutely massive capital requirements. Look right out of the gate. We have to acknowledge the unbelievable scale of what they've built here. Over 200 Falcon 9 launches. They literally figured out how to land and reuse orbital rockets, which the entire industry used to think was basically impossible, and they did it with an incredible reliability record. Add to that over 6,000 Starlink satellites currently in orbit serving more than 3 million global subscribers. Honestly, it's just a factual assessment to say SpaceX has done more to advance rocketry in the last 20 years than NASA managed in 30. That's the hype. And to be fair, that hype is backed by some very real historic engineering triumphs. So how does this operation actually make a buck? Well, there are two main engines here. First, you've got the launch business. They're charging around $67 million for a Falcon 9 flight, moving cargo and crew for heavy hitters like NASA, the DoD, and commercial clients. $67 million sounds like a ton of money, right? But executing a rocket launch is absurdly expensive. You're paying for fuel range fees, recovery ships, and intense refurbishment, so those margins, they are razor. Then you've got Starlink at roughly $120 a month per subscriber. You're looking at nearly $4 billion in annualized revenue. Starlink is clearly the real growth engine, but here's the catch. It's currently unprofitable. Building all those satellites and the ground infrastructure is burning through billions. So basically, the high-cost launch business is acting as a funding mechanism for Starlink, which is still a highly capital-intensive, unproven growth thesis. If we want to figure out if this valuation makes any sense at all, we just have to do the math. SpaceX brought in an estimated $9 billion of revenue in 2023 while holding that private valuation of $210 billion. Now compare that to the legacy aerospace giants Boeing, Lockheed Martin, and Northrop Grumman. If you combine them, they are pulling in over $150 billion in annual revenue, and yet combined, those three legacy companies are worth less than SpaceX. Think about that. SpaceX is currently being valued at an absolutely staggering 23 times its revenue. That 23 times revenue figure is what we in the industry call a tech multiple, and this right here is our first massive red flag. As financial analysts, you cannot scale rocket hardware margins simply by writing a few more lines of code the way you can with a software company. Every single additional launch requires heavy physical infrastructure, raw materials, fuel, and intense human labor. The margins just don't expand the way software does now. Sure, Starlink is a bit closer to a tech business because of the recurring subscription model, but real profitability there is still years out simply because they have to constantly launch and replace degrading hardware in low Earth orbit. To actually make that $210 billion valuation pencil out, Starlink would likely need to be worth up to $200 million all on its own, meaning they have to aggressively scale from 3 million subscribers to something crazy like 50 million subscribers, all paying $100 a month. Hitting a number like that means they have to absolutely dominate underserved markets, rural areas, maritime aviation, all while going head-to-head with incredibly well-funded competition from existing fiber networks, 5G rollouts, and Amazon's upcoming Project Cooper. The math required to justify this valuation relies on some extremely aggressive assumptions, and if you've been in the market long enough, you know that aggressive assumptions almost always end up disappointing. Now, let's look at the elephant in the room. Getting to Mars is central to the entire SpaceX identity. It's their mythology. The founder wants to make humanity multiplanetary using the massive Starship rocket, and again as a technological endeavor. It is genuinely awe-inspiring. But putting our analysts' hats back on, we have to ask a really uncomfortable question. What is the actual tangible financial return on investment for colonizing Mars? We are talking about $100 billion for Starship development, life support systems, habitats, food and energy generation. Every single piece of it sits straight from Earth. The blunt truth here, there isn't one, not financially anyway. Colonizing Mars is a philosophical project. It's a civilization project which is super admirable, but it's not a business. Right now, private investors are fronting this, but after an IPO, it's the public shareholders who will be footing the bill. The hard-end revenue generated by Starlink and those government launch contracts is going to be funneled directly into a Mars mission that offers absolutely zero financial return to the people holding the stock. So congratulations. As a prospective public shareholder, you might literally just be paying for someone else's very expensive sci-fi dream. So the founder owns roughly 44% of SpaceX, and through super voting rates, he firmly controls the entire company. From an investment perspective, this is a massive governance risk. Retail investors who buy in at the IPO are going to be minority shareholders in a company where one person dictates every significant decision you can't vote out, and you have zero influence over the strategy. You are entirely along for the ride, no matter where he decides to steer the ship. And that leads directly into Kerman risk. Any serious institutional investor is going to heavily discount a valuation based simply on distraction. SpaceX is just one of 6 completely separate companies this founder is trying to run at the exact same time you've got Tesla X, xAI, The Boring Company, Neuralink, and SpaceX. The entire vision, the risk tolerance, and the ultimate judgment of this massive aerospace company rests on one highly distracted individual. If he steps away or becomes unable to lead for any reason, the fundamental nature of SpaceX changes overnight, and that's before we even touch on the external roadblocks. They are facing severe regulatory hurdles from strict FAA launch oversight. Environmental groups are constantly challenging their launch site operations. Starlink is fighting international spectrum disputes in practically every global market it tries to enter. Plus, a huge chunk of their revenue relies heavily on government and NASA contracts. Now, government money is usually stable, but it's also deeply political if operational risks or public behavior makes the company too controversial. Those massive lucrative contracts could easily be shifted over to competitors like Blue Origin or ULA in a heartbeat. Ultimately, we have to separate this company's incredible engineering from its stock. Being a transformative company that changes the course of history does not guarantee you'll get profitable investment returns. Just look at the history books. The Concorde was completely transformative for supersonic flight, right, but its investors lost absolutely everything. Arium revolutionized satellite costs back in the 90s, and the tech totally worked, but the business still filed for bankruptcy in 1999. Space is just exceptionally hard. One single catastrophic failure like a Starship accident or a satellite cascade could set this company back years and cost billions. Remember, when you buy a stock, you aren't buying a rocket, you are buying future cash flows, and right now you'd be paying a gigantic premium for a story. So that leaves us with one final thought. SpaceX is undeniably one of the most impressive engineering outfits humanity has ever built, but impressive and investable are two very different things. Smart institutional money cares about cash flows, not flashy YouTube launch videos. So when that bell finally rings on IPO day, you really have to ask yourself, are you investing in smart, scalable cash flows? Or is this going to be the most expensive lesson ever in the difference between a philosophical mission and a profitable business? Thanks for joining me on this explainer. Keep analyzing, keep asking the hard questions, and I'll catch you next time.